Hi, welcome back. Every year I go through a ritual where I compute the equity risk premiums for individual countries at the start of the year and then I revisit those estimates in the middle of the year. In most years, the difference between the two numbers is small enough that you can ignore it and you're saying, why bother? This year, though, the difference is significant for two reasons. The first is the retreat of risk capital, which I talked about in my last session. Whereas risk capital is withdrawn, whether it's venture capital money or the investments in the riskiest companies, you've seen risky companies get repriced more than safer companies. Now, of course, in the context of countries, it takes the form of risky countries versus safe countries, or if you prefer the terminology that many asset allocators use, emerging markets versus developed markets. As risk capital retreats, you should expect to see equity risk premiums in emerging markets rise more than in developed markets. The second, of course, it's been a consequential year in terms of individual events that affect country risk. The biggest, of course, was the Russian invasion of Ukraine, which set off a whole set of events. Of course, the risk premiums for Russia and Ukraine increased, but so did the risk premiums for other countries in the region. You also had individual countries get into trouble, and their risk premiums reflect that. Sri Lanka and Pakistan in Asia, El Salvador in Latin America. So as we go through the numbers, you're going to see these countries have the biggest changes in equity risk premiums because of events during the year. So with no further ado, let's start talking about country risk and why country risk can vary across countries. Now, I think it's pretty obvious that some countries are riskier to operate than others. But the question is why? What is it about countries that makes some countries riskier than others? Well, I can isolate at least 4 factors that can cause country risk to vary across countries. The first is political structure. How free is the country? How much democracy is there? Now, remember, this is the effect of whether political freedom/democracy on business risk is a complex one. At the risk of sounding callous, democracies expose businesses to more continuous risk. Why? Because when elections happen and new governments come in, rules and regulations can change. A democratic government cannot promise you laws and regulations that will not change for decades. In contrast, a dictatorship can. And in fact, many businesses are attracted to operate in authoritarian regimes precisely for that reason. It's more predictable until it's not. The risk of operating in an authoritarian regime is when change comes, it's more likely to be disruptive and violent and much more difficult to deal with. So the way to think about this is democracies create more continuous risk, but authoritarian regimes create more discontinuous and sometimes catastrophic risk. The second force that causes country risk to vary across countries is the degree of violence and war that a country is exposed to. Let's face it, it's much more difficult to operate a business if you're surrounded by violence, whether the violence comes from external sources, war, or internal sources, internal strife, terrorism, because the cost of operating a business in a violent environment is higher. Those costs can take the form of insurance that you've got to buy or actual costs you got to impose, security guards, for instance, to run your business. The third force that can cause country risk to vary across countries is corruption. Corruption operates as a hidden tax. Why? Because to operate in a corrupt country, you have two choices. You can either play the games that the corruption requires you to play, pay bribes, pay those extra amounts you need to operate, which pushes up your costs, or choose not to play, in which case you lose business to your competitors who are less scrupulous than you are. And finally, there are legal and property rights. A business is only as valuable as the protection it's offered by legal systems for its physical and intellectual property rights. So countries which have stronger property rights are easier to operate in companies with weaker property rights. And it's not just how strong the laws are that protect you, it's how timely the legal system is in enforcing your rights. A legal system that takes forever to impose your rights is no better than a legal system that doesn't offer any rights at all. So let's see how the world looks on these 4 dimensions. Let's start with political freedom/democracy. The Economist Intelligence Unit, EIU, every year computes what it calls a democracy index. And it classifies countries into 4 groups: full democracies, flawed democracies, hybrids, which are kind of mix of democracy and authoritarian regimes, Let me start with the bad news first. In 2022, when the EIU did this update, it noted that only 6.4% of the globe's population, the world's population, was in full democracies. A good third of the world is in authoritarian regimes. In fact, if you look across regions, you can see the differences across regions of the world. North America scores highest on democracy. The Middle East scores lowest. Latin America saw the biggest drop-off in democracy scores in 2021. As a business, the question is, how does this affect you? And as I mentioned, it is a trade-off. On the one hand, if you operate in a democracy, you face this constant changing of rules and regulations that can be incredibly frustrating. In contrast, if you operate in an authoritarian regime, you're given predictability. The government can promise you that laws won't change and deliver on that promise until the government itself is overthrown. So as businesses, this question of which do you value more, which do you care about more, continuous or discontinuous risk, often determines how exposed to risk you are based on what kind of political system you operate under. Let's move to the second force, which is violence and risk and how they vary across the world. The Global Peace Score is a score which looks at the degree of violence that countries are exposed to, either from without war or within, from terrorism and internal strife. You can see the middle of Africa is red, with its degree of violence is significant. Russia, because this was done after the Russian invasion of Ukraine, Russia and Ukraine are red. In fact, it spills over into a lot of Central Europe. And if you look across the world, you can see that there are parts of the world where operating a business is dicey at best. So violence and risk varies across the world. And as we go through these charts, what you're going to see, what you will notice is that the same parts of the world show up as red in pretty much every chart. Let's look at corruption and risk. As I mentioned, corruption makes business more difficult. It makes it more difficult to run a business. And this chart actually presents corruption around the world. Again, the red parts are the most corrupt parts of the world. The green parts are the least corrupt parts of the world. Northern Europe is the standout here in terms of the least corruption. North America, Australia, and the rest of Europe don't look bad. Parts of Africa, again, look bad. Again, many of the same parts are exposed to war and violence and have non-democratic systems. Latin America and much of Asia still has degrees of corruption that affect how you run a business. And finally, if you look at legal protection, how it varies across the world. The part of the world where legal protection is strongest is actually Australia, followed by North America, and then you see the parts of the world where you get the least protection. Africa, for instance, South America. So again, from a business standpoint, the reason this matters to you is because your capacity to run a business is constrained by how strongly the legal system protects your property rights. So with all these multiple dimensions of country risk, is there a way we can convert all of this into one country risk score? Well, no harm trying. And there are services that do. The World Bank does it. The Economist does it. And one of my favorites is a service called Political Risk Services. It's a Europe-based entity that measures country risk with a score. The lower the number, the riskier a country, the higher the number, the safer the country. So this is their latest update from mid to 2022. So if you look at the safest countries, no surprises. Norway, a lot of Northern Europe. You get Taiwan, which makes it from Asia into that list. And you also see Canada from North America on that list. On the riskiest, again, no surprise. You got a lot of war-torn countries, Lebanon, Syria, Sudan. Turkey makes an entrance into the top 10 list for the first time in a long time. Riskiest countries. If you look at the picture, you'll again see that the green parts are the safest parts of the world according to PRS, North America, Europe, Australia. But parts of Asia too, India and China have now made it into the safer parts of the world. Africa is some of the riskiest part of the world. But overall, it's a picture of country risk that tries to bring in composite factors, many factors into its fold. So with that lead in, let's talk a little bit about more specific measures of country risk. If you're a lender to a country, what you care about most is default risk measures. And in the middle of 22, or leading into 2022, a chunk of the world was already in default already. This is actually a picture of countries already in default, showing the percentage of the total debt of the country that's in default. So you can look across Africa, lots of countries already in default. Argentina, of course, is always in default. Parts of Asia are in default. So default is clearly a clear and present danger when you're lending to a company. Of course, there are ratings agencies that have stepped in and tried to quantify or at least come up with a measure of this default risk with a rating. This is actually the picture of Moody's ratings, sovereign ratings, based on foreign currency ratings for different countries in the world. Again, green parts of the world are, the greenest is AAA rated countries. You see Australia, US, Canada, parts of Europe, but relatively infrequent. Singapore is the only Asian country that makes it into the AAA list. Then you get investment grade, Baa3 all the way to AA1, and you can see that India and China have made investment grade, portions of Africa too. And if you look at Latin America, there are sections of Latin America that make investment grade, Chile, Peru, Colombia. And then you get to the orange and red parts, and these are the riskiest parts of the world. Not only are they below investment grade, they're way below investment grade. Again, Russia's invasion of Ukraine has pushed it below investment grade. In fact, Russia's rating, which was dropped to CA after the invasion, is now not, Moody's has withdrawn its rating entirely. But you can see that default risk varies across the world. But this is based on how ratings agencies see the world. I know some of you don't trust ratings agencies, either because you believe they have regional biases or because you believe they're late to the game. It takes a long time for ratings agencies to adjust their ratings. So for those of you who don't like ratings agencies, I have a second or a different measure of default risk. It's a market-based measure. It's sovereign CDS spreads. Now the downside here is you have sovereign CDS spreads for only about 80 countries, half of the world. But it's an updated number and it reflects what markets think at that point in time about default risk across the world. Now you can compare the two graphs, the one for sovereign CDS spreads with the sovereign ratings, and you're going to see a lot of overlap. Ratings agencies are not that bad at assessing default risk. But here, the reddest parts of the world again are the countries with the highest sovereign CDS spreads, the most default risk, at least through the eyes of the market. Now, of course, as an equity investor, you might say, well, why does that matter for me? Well, as an equity investor, you have to think about equity risk premiums by country, and risky countries should have higher equity risk premiums. Now, I don't claim to own the right way to doing it, but I have a way that of estimating equity risk premiums that I've used for the last 30 years, and I go back to it. I've finessed it, I've refined it, but it's still a work in progress. Here's how I get the equity risk premiums for individual countries. I start with the equity risk premium for the S&P 500, which, as you know, I do at the start of every month. At the start of July, that equity risk premium was 6.01%. For every country, I look for a rating, a sovereign rating. If I can find one, I use the sovereign rating to come up with the default spread for the country. If I cannot find a sovereign rating, I use the PRS score for the country. And I try to come up with a default spread based on the PRS score. And then I scale up that default spread. Let me explain what I'm trying to do here. The default spread is what I would charge for buying a bond issued by the country. But if I'm investing in equity, I'm exposed to more risk than just buying a bond issued by the country. That scaling measure captures how much riskier equities are than bonds, and I use a very simplistic approach to get it. I compute the standard deviation in an S&P 500, S&P Emerging Market Equity Index, and then I compute the standard deviation in an S&P Emerging Market Government Bond Index. Then I look at the ratio of these standard deviations. In July of 2022, that number was 1.16. Let me give you an example of how this would play out. If you have a country with a default spread of 2%, I would multiply the 2% by 1.16. That's going to give me 2.32%. Add that on to the 6.01%. I get 8.33%. That would be the equity risk premium for a country. So let's see how this approach plays out as estimated equity risk premiums at the start of July 2022. This page, I've essentially taken my base premium for the US, 6.01%, the implied premium for the S&P 500, and given it to every AAA rated country in the world: Canada, Australia, New Zealand, Germany, the Netherlands, Singapore. But for countries that are not AAA rated, I use the default spread based on the rating, scale it up by that scalar of 1.16 to come up with the country risk premium and add that to the 6.01%. So if you take India as an example with a Baa3 rating, the default spread scaled up gives me a country risk premium of 3.07%. Added to the 6.01% gives me a total equity risk premium of 9.08%. For Brazil, with a rating of BA2, I get a country risk premium of 4.21%. That's a scaled up value. Added to the 6.01% gives me 10.22%. The top right hand corner are the countries that I call frontier markets. These are countries without ratings. And for those countries, I use the PRS score, the country risk score we talked about earlier, to come up with a country risk premium and an equity risk premium. Now, while equity risk premiums around the world have jumped over the last 6 months because the base number has gone up from 4.24 to 6.01% and the default spreads are widened, there are some countries where the jump has been more significant, larger than the rest of the world. This chart, I've highlighted the countries with the biggest changes in ERP. The first two are no surprise. Russia has seen more than a tripling of its equity risk premium from 6.42% to more than 22%, followed by Ukraine and Belarus, which are both in the location of which are in the immediate war zone. But you can also see that there are 3 African countries which made it on the list, partly because of downgradings: Mali, Namibia, and Ghana. And El Salvador made it because of its ill-fated expedition into the Bitcoin experiment that it ran on currencies. And Sri Lanka, where the political system has melted down. So you can see that equity risk premiums for some countries have changed more than others. Which brings me to the final component of what I want to talk about, which is currencies. The minute you start talking about moving across countries and globalization, you've got to start talking about currencies. In this graph, I've estimated risk-free rates by currency. For some currencies, it's easy, right? UST bond rate, that's a risk-free rate in dollars. These are the risk-free rates in currencies where there is no default-free entity. And at the risk of stating the obvious, those risk-free rates vary by currency. There are some currencies with high risk-free rates like the Zambian kwacha and other currencies with lower risk-free rates. Now, if you're wondering why risk-free rates vary across currencies, the hidden ingredient is always expected inflation. High inflation currencies have high risk-free rates, low inflation currencies have low risk-free rates, and deflationary currencies could have negative risk-free rates. That is why when you do valuation, you've got to be currency consistent. In other words, the currency in which you estimate your cash flows and the currency in which you estimate your discount rate have to be matched up because you need the same expected inflation in both. In practice, often you get mistakes because people mix and match. They mix currencies estimated, the cash flows estimated in one currencies with discount rates in another, real cash flows with nominal cash flows. But the key is to make sure that you're building in the same expected inflation components into your cash flows and your discount rates. As a general principle, when you think about estimating discount rates, each component of a discount rate carries a weight and it should be allowed to carry only that weight. Your risk-free rate should reflect the currency in which you're doing your analysis. And as you can see, risk-free rates vary across currencies. Your relative risk measure should reflect the business or businesses you choose to be in. And equity risk premiums and default spread should reflect the price of risk in the market you're in. So if you're whichever geographies you operate in, that should play out as an equity risk premium, and your default spread should be based on your default risk. And if you think about how these numbers have changed over the course of the last 6 months, risk-free rates are up across the board, not just in the US dollar, but in every currency. And as you saw, equity risk premiums have jumped across the board as have default spreads. Not surprisingly, the way this plays out, if you compute the cost of capital for global companies, and this is a distribution of cost of capital, you get a very different distribution than the one you got just 6 months ago. The median cost of capital for a US company now is 8.97% in US dollar terms. The median cost of capital for a global company in US dollar terms is 9.7%. You're saying, so what? Those numbers just 6 months ago were very different. The median cost of capital for US companies 6 months ago was 5.77%. It's gone up by 3.2%. The median cost of capital for a global company has gone up from 6.37% to 9.7%. It's been a most momentous 6 months in terms of shifts in cost of capital. And using one of Bob Dylan, one of my favorite lyrics from Bob Dylan, the times they are changing. Now, you have a choice. You can stay stuck with what you're doing the way you've always done them, perhaps the last 10 years or even the last 20, or you can change with the times. I think we're facing a very different market environment than 6 months ago. And those rules of thumb that worked 6 months ago won't work anymore. I wish you the best. Thank you very much for listening.